All right, let's jump right into this explainer and learn exactly how to take control of your finances, battle the invisible thief that is inflation, and build real, lasting wealth using the stock market. Welcome, everyone. I am absolutely thrilled you're here today because we're unpacking a topic that can quite literally change your financial trajectory. The stock market often feels like this incredibly complicated, exclusive club, right? Well, it really isn't. Today, we're going to break it all down step by step using some incredible source material we've put together for you.
Here is our game plan for today. 1. Why invest in stocks? 2. The anatomy of a company. 3. Choosing your investment vehicle. 4. Evaluating financial ratios. And finally, number 5, executing trades and taxes. Let's get to it.
Section 1. Why invest in stocks? The battle against inflation.
To really grasp why the market matters, we first have to face a pretty harsh truth about cash. As our source bluntly puts it, savers are losers. And I know that sounds rough, but sitting on cash in a standard savings account means you are silently losing your purchasing power over time to inflation. Think about it. If everyday things cost 5% more this year, but your cash only grew by 1 measly percent, you've actually gone backward. But historically, the stock market has averaged roughly a 10% annual return. Let that number sink in. That 10% makes the stock market one of the absolute best tools in human history to outpace inflation. And the best part is, you don't have to be some Wall Street genius to get in on it. You just need to understand what it is you're actually buying.
Moving right along to Section 2, Anatomy of a Company, or Slicing the Corporate Pie.
So what are we actually doing when we invest? Well, when you buy a stock, you're buying an equity stake. True ownership in a living, breathing business. We measure a company's total size and value using something called market capitalization, or market cap. It's a remarkably simple formula. You just take the total number of shares out there in the world and multiply it by the current share price. Boom. That tells us exactly how the market values the entire company at this exact second.
To visualize this, just think of a company like a giant pizza. If there are 4 slices total, meaning 4 shares outstanding, and each slice costs $1,000, the total market cap of that pizza is $4,000. Obviously, massive companies like Microsoft have billions of slices, but the underlying math is exactly the same.
Now, when companies issue this stock to raise money, say to fund research or pay down debt, they generally issue 2 types. Mostly, you'll be buying common stock. This gives you a voting right in the company's major decisions, which is cool, but it puts you dead last in line to get paid if the company goes bankrupt. That's a bit different from preferred stock, which strips away your voting rights but actually bumps you up higher in priority for dividends and liquidations.
You're also going to see these companies categorized by their market cap. You've got your large, mid, and small caps. A large cap is a massive, established titan, over $10 billion. You'll also see them grouped by how they behave. Growth stocks are the aggressive ones, constantly reinvesting everything to expand. Income stocks are the stable, reliable ones paying you consistent dividends. And then there are value stocks. I love how our source describes these. They're like the ugly puppies at the shelter. They might look a bit rough and unloved by the market right now, but they're actually deeply underpriced and have huge potential once you clean them up.
Section 3. Choosing your investment vehicle and managing your risk.
Okay, so now we know what stocks are, we have to pick our investment vehicle. And look, to invest is to take on risk, period. Risk is simply the chance that your outcome differs from what you originally expected. And as you can see, there are a ton of flavors here, from sweeping market crashes that drag everything down to concentration risk where you foolishly put all your eggs in one basket. But here is the critical takeaway. Risk isn't just some negative thing you try to avoid. Risk is exactly what you are being compensated for as an investor. The higher the risk, the higher your potential reward absolutely has to be to justify taking it.
When you're looking at your options for managing all that risk, you might think about picking individual stocks. That gives you total control and zero management fees, sure, but our source makes a great point. You'd need 20 to 100 individual picks just to be properly diversified. Talk about exhausting. And that right there is exactly why baskets of stocks like index funds or exchange-traded funds, ETFs, have become incredibly popular. They give you instant diversification across hundreds of companies with extremely low fees, taking the headache out of the whole process.
All right, on to Section 4, Evaluating Financial Ratios. Time to crunch some numbers.
Let's say you're determined to pick individual stocks anyway, looking for those hidden gems. You don't have to be a math genius, but you do need to know how to look under the hood. All the ratios we are about to explore come directly from 3 foundational documents every public company has to release.
The balance sheet, which gives you a snapshot of their health frozen in a single moment. The income statement, which tracks their revenues and expenses over a period of time. And the cash flow statement, tracking the literal cash moving in and out of the front door. Now, to save us from total cognitive overload, because staring at spreadsheets can definitely make your eyes glaze over, we group these financial ratios into 5 handy buckets. This structured approach lets us quickly and accurately analyze a company's true health across valuation, profitability, liquidity, solvency, and efficiency.
Let's kick it off with valuation. We typically use the price-to-earnings, or PE ratio, alongside the price-to-book ratio. These essentially tell us if a stock is a bargain or way too expensive relative to its actual performance. Just for context, the source material showed Microsoft's PE hovering around 36 at the time. Compare that to the traditional healthy benchmark of 15, and wow, it clearly indicated the stock was trading at a massive premium. It just gives you a solid standard to compare apples to apples.
Next up is profitability, specifically return on assets, or ROA. A healthy ROA is typically around 5% or higher. This metric is absolutely fantastic because it tells you exactly how efficiently the management team takes the assets they already have and turns them into cold, hard profit. Like the source brilliantly notes, did they take lemons and actually make lemonade?
And that flows beautifully right into efficiency. Just look at Walmart here. They utilize their assets at a staggering rate of 2.3 to generate sales. They are significantly outpacing competitors like Target and completely dwarfing capital-heavy telecom companies like AT&T. It proves Walmart is an absolute machine when it comes to moving inventory and generating revenue from its assets.
Which brings us to our final section, Section 5, Executing Trades and Taxes, Making the Move.
So, you've evaluated a company, checked the ratios, and deemed it a solid, healthy investment. How do you actually buy the thing? Well, executing a trade today is ridiculously simple. Using modern zero-fee brokerage apps, you don't even need hundreds of dollars to buy a single share anymore. As the source showed, you can literally buy fractional shares. If Microsoft is trading at $225, you can just say, hey, I want to invest $50, and the platform automatically slices off the exact fraction of that share for you. It completely removes the barrier to entry. Anyone can start.
But wait, when you hit buy, you have to choose your order type, and this is absolutely crucial. A market order tells the broker, I want this right now, whatever the current price is. It fills instantly. But a limit order? That is your protective shield. It tells the broker, listen, I only want to buy this if the price drops to my specific target. It just sits there pending until the stock reaches your chosen price, totally guaranteeing you won't overpay just because of a sudden random price spike.
Okay, boom. You did your research, your limit order hit, the stock popped, and you sold it for a profit. You're feeling like a financial genius. But now what?
Well, now we've got to talk about the tax man. Because making money in the market triggers a taxable event known as a capital gain. And here's the secret. The government literally taxes you based on your patience. If you hold that stock for less than a year before selling, your profit gets hit with a short-term capital gains tax, which is basically just your regular everyday income tax bracket. But if you hold that asset for over a year, you are rewarded with long-term capital gains. These offer significantly more favorable rates, sometimes as low as 0 or 15% depending on your income. Patience quite literally pays off.
We've covered a ton of ground in this explainer today, from understanding market caps and asset turnover to placing that very first limit order. But it really all loops back to this core philosophy from our source. Savers or losers, everyone knows that having assets is better than just sitting on cash. Holding appreciating assets is your best shield against the continuous, silent drain on your purchasing power.
You now have the foundational knowledge. You know how to check a company's health. You understand the vital difference between market and limit orders, and you recognize the risks and the tax rewards. So I leave you with this final thought to chew on. Are you going to let inflation silently erode your hard-earned cash, or are you ready to finally claim your slice of the market pie?